Hello, everybody. Good morning, good afternoon. I am Joe Gallimore, Director of Investment Research with Argent Bridge Advisors, and welcome back to Cup of Joe. So stock indexes had a strong bounce back week, the 5 days ending March 18th. It was actually the best week in the US stock market since November of 2020, about 16 months ago. The S&P 500 recovered a little over 6%. US small caps were up almost 5.5%, and international stocks represented by the MSCI EAFE index, those gained about 5.6%. So maybe it was the luck of the Irish, but it's unclear exactly what sparked that rally. But gains were seen across pretty much all stock asset classes. Hopefully, this is an indicator that there is investor optimism beneath the surface that is being stymied by the heightened uncertainty resulting from the war in Ukraine. Bonds trended downward still as the Fed followed through on its widely broadcasted intention to raise interest rates, which happened Wednesday of last week. Although the Fed board would like to remain accommodative during this period of economic disruption caused by the war in Ukraine, they made it clear that they simply couldn't not act in the face of very high inflation. So they took the first step towards curbing that inflation. Now, some of you may think or may have heard or been misinformed that rising interest rates are bad for the stock market, but this is not necessarily true. First of all, some sectors actually benefit from rising rates. Those may include financials, industrials, and materials. Secondly, empirical evidence doesn't necessarily support that claim. My colleague Eric shared a stat with us yesterday, published by LPL Research in Bloomberg, that said since 1983, 12 months after the initial rate hike of a rising rate cycle, the stock market has been positive 100% of the time. There have been 8 of those rising rate cycles, and the market is 8 for 8. Now, of course, that being true in the past does not guarantee that it will be true this time around, but we certainly like those odds. And third, remember that the main goal of the Fed rising rates is to cool off inflation, which is something we all ultimately want. Slowing down the rising cost of goods in our economy is naturally good for the end consumer. Slowing inflation, it allows the average household to maintain its ability to continue spending rather than having to cut back on expenses altogether. And at 68% of the US GDP, the consumer is the primary engine of the US economy. Now, finally, one important distinction to make here is that when we talk about inflation, in a class by itself is food and gasoline. The US Bureau of Labor Statistics actually carves out a whole separate inflation number to exclude these two because they're in a class by themselves. These are obviously staple items that all of us obviously must spend money on. And those are being greatly influenced by other factors. So hopefully a peace agreement in Ukraine is reached sooner rather than later. And when it is, I think there's a good likelihood that we'll see an immediate decline in the price of food and gas. So that's what we're hoping to see there. If you have any questions about anything we've discussed or anything else in general, please reach out to us at Argent Bridge Advisors, and we are happy to help. Take care.